With the inflation rate skyrocketing to the highest point in almost 40 years, ever-increasing prices of goods, higher production costs, and the lingering supply chain bottleneck nightmare, it's no surprise that some investors are in full-blown panic mode trying to find the best place to park their hard-earned cash. Today, I'm going to explain how inflation works, why it's so high, and what you can do to protect your money from losing value. By the end of this video, I'll also show you some other investing options that can help you hedge against inflation when it gets out of control like this, so be sure to stick around until the very end, and hopefully this information can give you at least some peace of mind. Before I begin, my name is Caleb. Subscribe for more content just like this. Now let's begin. So according to the latest CPI report, which measures the percentage change in prices for all types of goods and services, there's been a massive 7% increase in the last 12 months alone. Now 7% might not seem like a big number, but to put this in perspective, the last time we saw inflation rates in the sevens was almost 40 years ago, back in June of 1982. From then until now, the average rate of inflation was about 2.7% per year, and according to the Federal Reserve, the acceptable inflation rate is around 2%, so 7% is quite a lot. But why is inflation so high? Now, of course, what caused this is pretty much just COVID, but to get more specific here, inflation is typically caused from an increase in production costs, or when there's a higher demand for products. When production costs or demand goes up, the price of said item also tends to increase, which means each of your dollars is able to buy less tomorrow than it can today. For example, if you took $100 back to 1960, you would have the same purchasing power as $886 would have today, because prices used to be much lower back then. In 1960, you could find a new home for around 13 grand, a gallon of gas was 25 cents, the average car was only $2,500, and a jug of milk you could find for under $1. So just to bring it full circle here, basically COVID happens, people spend less money, the Fed drops interest rates to the floor and starts churning out the stimulus checks from their lovely money printing machine, and then we start to reopen and suddenly there's a massive demand for products with increased consumer spending, all of which is happening right in the middle of an endless supply chain disruption and labor shortage. I mean, how much worse can it get, right? It's the perfect storm. Now for those of you watching, there's two main things to be concerned about here. The first one is any cash you have saved, whether it's physical dollars or in a bank account, is losing its buying power more and more every day that it sits there, which means at 7% inflation, $100 today would only be worth $93 a year from now. And number two, anything you make from your investments is worth less because inflation cancels out the interest gained. This means that if you're expecting an annual return of around 9% for your stock portfolio, but inflation is 7%, then you're really only getting a value increase of 2%. Both of these things are definitely not okay in the wealth building world, so I'm going to teach you how to protect the value of your money and some different investments you can make to help hedge against high inflation. Alright, so you have a big pile of cash in a safe somewhere or chilling in your bank account. Where should we put it so it doesn't lose its buying power, and is it even possible to outpace 7% inflation? Well, the first thing to look at is stocks and bonds. The S&P 500 is an index of the 500 largest public companies traded in the United States, and historically this index has had an average annual return of just over 10% for the last 64 years, but this is without inflation. If you adjust this number for inflation, it brings the average return down to around 7% on average per year, but like I said, the average inflation rate is only around 2 to 3% during a normal year, so with 7% inflation, those annual returns of 10% would be brought all the way down to just 3%. Normally I'd consider 3% to be a bit skimpy, but during a time like this, you'll want to take any gains that you can get your hands on, so I'd say 3% is a good start, and you can help increase this percentage if you invest a little bit more each time the market dips. Since the inception of the S&P 500 back in 1957, there's never been a loss in a single 20-year period, so if you plan to hold your money long term, this is a great spot to hold your cash. The next thing in this category that you could try investing in is commodities, which are things like agricultural goods, precious metals, electricity, oil, and natural gas. Historically, commodities and inflation have had a unique relationship where when inflation is higher, commodity prices tend to rise too. Now with this one, it's important to remember that commodities can be pretty volatile because supply and demand are what drive these prices, and a lot of what impacts this can be pretty unpredictable. For example, if there's a drought, prices of certain crops could go up from fear that future supply will be lower. Or if the weather is extra cold one winter, the demand for natural gas goes up since everyone wants a warm and cozy home. So if you plan to take this route and move more money into commodities, be careful not to have too much of it in this one sector. Commodities can help combat inflation, but historically it's not normally an asset that appreciates very well. Of the 10 years leading up to 2020, commodities only gained value overall during 3 of those years. So with inflation so high, adding a slightly higher percentage of commodities to your total investment portfolio could be an option, and you can actually invest into a broad selection of commodities through an ETF, like the iShares GSCI Commodity Index Trust under the ticker symbol GSG. Just remember, stay diversified, understand the risk, and do your research first. The last investment in this category worth mentioning is a thing called TIPS. And no, I'm not talking about tips like what you give your restaurant server. I'm talking about TIPS, or Treasury Inflation Protected Securities. Now, TIPS are a type of treasury bond specifically designed to protect investors from inflation, or in some cases help you actually profit from it. As inflation rises, TIPS have their prices adjusted to maintain the real value, and they pay interest twice per year at a fixed rate. Unlike typical bonds, the interest rate is applied to the original price of the bond, so if inflation causes the base price to go up, then the interest rate is getting applied to a bigger number, which means a bigger payout. Since TIPS are a type of treasury bond, they also come with a maturity date, and the options here are 5, 10, and 30 years. At the date of maturity, TIPS return the adjusted principal or the original principal, whichever is greater. Now, I know this might be a little confusing, so let me give an example here. Say you have $1,000 in TIPS at the end of the year with an interest rate of 1%. If there's no inflation, then you'd receive $10 that year. Now, if inflation was 2%, the $1,000 in principal will also be adjusted by 2%, which would be $1,020. The interest rate here is still the same 1%, but instead it's getting applied to an adjusted principal amount of $1,020, which would result in a payment of $10.20 at the end of the year. Now, on the other hand, if we had deflation and prices were down 2%, then the principal gets adjusted down to $980, and the resulting interest payment would only be $9.80. However, if you hold the TIPS until maturity, you are guaranteed to still receive the original $1,000 at a bare minimum. So as an investor, you are never really at risk of losing the original amount if you hold until the maturity date, but if you decide to sell before the maturity date, then you could receive less than what you paid. The other thing to keep in mind is when the price is adjusted, the IRS considers this increase to be taxable income, so another option is to hold these TIPS in a tax-deferred retirement account like a Roth IRA. TIPS are usually on the low end when it comes to interest paid, so they're not very optimal for investors looking to generate income and growth, but they're great for temporary inflation protection in particular, so if you want to check out a decent ETF for TIPS, you could try the iShares TIPS Bond ETF, unsurprisingly under the ticker symbol TIP. Alright, so now we've covered the things from the stocks and bonds category, but what else is there for those that have more money on hand? Well, the next place I'd point you is real estate, and there's a few different ways that you can approach this. The first one, of course, is just straight up owning properties. Historically, there tends to be a strong correlation between inflation and any asset with a limited supply, such as real estate. In general, as the money supply increases and interest rates decrease, which we've seen a lot of in the last year and a half, then buying real estate becomes more affordable, thus increasing demand, which causes prices to go up. This effect is most easily seen in larger cities where land is more limited, which means the supply remains the same while demand goes up for what's still available. Over the last 25 years, commercial real estate for investment purposes and residential real estate had an average annual return almost identical to the S&P index, sitting right above 10%. Now, we have to be careful when we compare the stock market to the real estate market because they're two vastly different assets with different variables that impact performance and price, so I wouldn't go all in on either of the two. The important thing here is that real estate is a tangible physical asset with real usage, and the demand for homes and buildings will probably never go away. In a way, because of the fact real estate serves an actual purpose as opposed to stocks or bonds, you could argue that real estate has an inherent value. And on top of that, even though wear and tear can cause the value of a home to depreciate over time, you can always renovate and make upgrades. With stocks though, if the price goes down, you can't just go in and paint the ceiling and upgrade the kitchen and call it a day. The key takeaway is that owning real estate is typically a great way to store value over a long period of time, and even though the performance can vary greatly from the performance of stocks, it still tends to beat inflation. On average, the stock market tends to move more during bull runs and crashes, but the housing market is slightly more stable overall, even though the returns aren't always as high. And if you're the one actually living in the home, a housing market crash doesn't really matter that much if you weren't planning on moving out soon. Even if your house lost 90% of its value in just a few years, this only matters when you sell, because at the end of the day, you still get the inherent value of owning a property and having a place to live that is yours. To take things one step further, you could look into rental income as a hedge against inflation, which is the second thing in the real estate category. Real estate income is earned when you rent out the property you already own, and this works well with inflation because when property values rise, so does the amount that you can charge for rent. This means that when inflation gets bad, you can raise the price of rent accordingly, and this will help cancel out the damage that inflation causes to some of your other investments. When you simply live in the house you own, you aren't actually making any physical money, but if you rent out the place to someone else, not only are you generating some sort of legit cash, but you also get to control how much cash you get. With this one though, you have to be careful because if the price of rent is too high, nobody can afford it, and if the price is too low, then you could start to lose quality with potential tenant prospects, so it's important to find a good balance when it comes comes to rent price. Real estate has a lot of expensive upfront costs though, and it's not very liquid of an investment, meaning you can't just sell your home overnight like you can with a stock, but overall there's a lot of benefits to owning real estate, and it can be especially helpful when it comes to combating high inflation. But wait, for those of you who don't own real estate or can't afford it, I still have one more option here for you, and that is REITs, or real estate investment trusts. REITs are basically ETFs for real estate where you can buy shares of it on a stock exchange just like the S&P 500, except for instead of owning shares of a company, you own shares of a broad range of properties. Every REIT is different, but a good diversified one could include residential homes, condos, apartments, commercial buildings, plazas, and even land itself. Just like stocks, you can earn interest on these investments when the prices of property goes up, and you can even get paid dividends from all the rental income that these properties generate. The two biggest risks with REIT investing come when either the Fed increases the interest rates, which can draw some funds away from REITs and into treasury securities, or when property taxes go up, which already make up a large portion of the operating expenses. Another thing to keep in mind is that dividends from REITs are usually taxed as ordinary income, which is generally higher than the tax rate for capital gains in the stock market. REITs are great for those who can't afford to buy a home, or for those who want to keep things simple and not deal with all the annoyances that can come from being a landlord and having to maintain properties. And a great REIT worth mentioning with broad exposure and a low expense ratio would be the Vanguard Real Estate ETF under the ticker symbol VNQ. Over the 30-year period leading up to December of 2020, REITs have also produced an average annual return of around 10%, which is on par with the S&P 500 benchmark. Now, if you're curious what types of real estate are the top performers, during the same time period, the top four were industrial, residential, healthcare, and self-storage properties, ranging anywhere from 10.9% all the way to 15.1% per year on average. The worst performers here were the mortgage REITs at 5.7%, which basically means the investment company hasn't paid off all the properties yet, taking away from the potential returns, and lodging or resort properties, which gave an unsatisfying 3.9% on average per year. So if you decide to check out some REITs, make sure you look at the specific types of property that make up the portfolio, and try to shoot for an REIT where the properties are already paid off and fully owned. What's great about rental income and REITs is you can generate a cash flow much faster than if you just owned a property and lived in it. Dividends get paid regularly, and most of the time it's every quarter, and rental income is paid monthly, so if you can get yourself into one of these, you'll start seeing returns within just a few months as opposed to waiting until you sell your home to see any kind of tangible monetary gain. Alright, so now we've covered stocks, bonds, and various ways to invest in real estate, all of which can help protect your wealth against inflation, but there must be some other options, right? Yes, there are actually several other options, which is the last category of investments I want to mention here, the first of which is gold and precious metals. Gold is probably the most common investment I hear about when it comes to hedging against inflation, and a lot of people even see gold as an alternate form of currency entirely. Gold, of course, is a real physical asset and tends to hold its value over time. The major drawback here is that gold doesn't pay any sort of yield like other assets do, which means that when the Fed starts to raise interest rates again to combat inflation, yields are generally higher for other assets, and gold might not be as valuable in comparison. Some investors argue that gold is actually losing its reputation as a reliable hedge against inflation, which in some cases can be true, so if you decide to go this route, you should just include it in your anti-inflation basket. Don't just throw all your money into just precious metals and call it a day. Over the long term, gold has been considered a decent hedge against inflation because it tends to maintain value, but the performance of gold on the short term is much less promising, and as time goes on, there seems to be less and less correlation between CPI data and gold prices. My personal conclusion here is that you shouldn't rely on gold if you want to outpace inflation, but if nothing else out there is outpacing inflation, or if stock prices are plummeting, gold might be something to keep an eye on. During the last 50 years, gold has produced an average annual return of about 10.6%, but if you look at only the last 10 years, gold has only returned 3.7% on average, whereas stocks had an average gain of 12.2% during the same time period. Something interesting though is if you look at this chart, which is adjusted for inflation, the time when gold was worth the most was back in 1980 when inflation peaked at around 15%. So for those who are interested, a good ETF for gold is the SPDR Gold Shares ETF under ticker symbol GLD. Now the second thing in this category is a bit more controversial, but it's been mentioned as a hedge against inflation more and more recently, and that is cryptocurrency, specifically Bitcoin. Cryptocurrency in general tends to have little to no correlation with traditional financial markets, which is why some investors call Bitcoin the new gold and believe that it's one of the best ways to preserve the value of your $100. Back in November of 2021, Bitcoin briefly touched $69,000 per coin, and that same day, the CPI data report came out at 6.2% year over year, which at the time was the highest yearly increase in 30 years. The main thing that draws people to crypto is the fact that most of them aren't tied to a particular currency or economy and can't be controlled by a small group of people or companies like stocks can. On top of this, cryptocurrency is an international asset class that reflects global demand, not just demand in your home country. When stock prices are at record highs and you still want returns up there in the 10% range like we've talked about, Bitcoin could be one of the better options because it avoids many political and economic risks. It's also way easier to purchase than real estate investments and has a limited supply like real estate, which inherently makes Bitcoin a non-inflationary asset. And also, just like gold, Bitcoin is scarce and easily interchangeable, but it's also arguably more secure and definitely more decentralized. Gold supply is controlled by powerful economies like the United States, China, and European countries, but Bitcoin is controlled by nothing other than supply and demand. On top of this, the vast majority of Bitcoin holders are doing just that, holding it. They aren't spending it and transferring it around very much, and most people treat Bitcoin like it's a safe full of cash. They take some when they need it, but most of the time they just let it sit. As far as returns go with Bitcoin, it's hard to make any comparison because not only has Bitcoin and many other cryptos grossly outperformed every other asset in the last 10 years, but investing in cryptocurrency has also become a huge trend for younger investors, so it's hard to see what the fair value price would be, let alone the fact that crypto is incredibly volatile. The last argument against Bitcoin is that gold has intrinsic value, whereas Bitcoin is just as imaginary as the US dollar, but Bitcoin's blockchain technology has practical use cases which can take it far beyond just being used as a cryptocurrency to buy, sell, and trade. Overall, crypto is clearly one of the riskiest investments on this list, but I think it's unfair to ignore this one, and the use cases of Bitcoin and adoption of crypto as a whole should only increase from here. Cryptocurrency and Bitcoin itself are by far the best representation of the risk equals reward concept, so be sure to understand what you're getting yourself into if you decide to include crypto in your portfolio, and remember, if you like crypto but can't stand the volatility, there's also some high yield stablecoin options out there too. So Bitcoin and gold were the two main other options I wanted to mention, but there's one more strategy, I guess you could say, that didn't really fit in the first two categories, and that is to invest in a high yield dividend portfolio. A high yield dividend portfolio is very similar to something like the S&P 500 index. However, its primary focus is to maximize the dividend payout ratio, which means most or all of the companies that don't pay dividends are left out. The trick here is some companies have huge dividends, but the stock itself could lose value at the same time, so it's important to find companies that have historically maintained or appreciated in value while also having a high dividend payout. Some investors will even include high growth non-dividend companies in their portfolio just to make up for the high dividend stocks that go down in stock price, which is another way to do it. The key idea here is that with a dividend portfolio, you can get paid dividends throughout the year and earn some money on the short term, whereas with traditional long-term stock investing, you typically don't see any real money in your hands until you actually sell the stock. So it's really a question of, do you want extra cash on the short term to make up for the lack of purchasing power, or do you want extra cash on the long term that can reliably outpace the rate of inflation? Aside from this, you also have to have a bit of knowledge when it comes to picking the individual companies, and sometimes it's hard to assess the true value of a stock when it pays high but has low growth potential. Also, companies can change their dividend payout at any time, which a lot of companies have done during the pandemic in order to save money. But historically, dividends account for about 40% of the total stock market return over time, and according to the director of market strategy at Fidelity, research shows that during periods of high inflation, stocks that increase their dividends outperform the broader market on average. So overall, a high dividend growth stock portfolio seems to be one of the best ways to outpace inflation, and in many cases outperforms the market too. So now that I've shared with you 9 different ways to potentially beat inflation, there's a few things to remember going forward. The first thing is to not let the idea of inflation protection be the prime dictator in your investment decisions. It's a bad idea to let the fear of inflation dominate your portfolios, and remember to maintain a long-term outlook. Inflation isn't going to stick around forever and everything is temporary, so make sure you're still looking ahead beyond these times of high inflation, and keep that in mind as you find a balance, which brings me to the next takeaway, and that is to diversify and rebalance as needed. If you're someone who wants to be hands-off, it's more than likely that someone else is rebalancing your portfolios on your behalf, like most ETFs and mutual funds do, and ETFs themselves are inherently diversified to begin with. But if you're someone who likes to pick your own stocks, build custom portfolios, and take more risks, just be sure to not have all your eggs in one basket. You need to plan for a multitude of economic outcomes, and if things head in an unpredictable direction, take another look at your investments and adjust the size of your allocations for each type of asset. It's totally okay to recalibrate your portfolios every once in a while, and during a time of economic turmoil just like this, you may have to put more energy into this than you normally would. And the last thing here is to not make dramatic portfolio changes or drastic decisions based on short-term fear. Like I said before, focus on the long term, look at historical historical data and do your own research. Don't just go all into gold and Ethereum just because you're afraid of losing 7% of that pile of cash sitting in your bank. All in all, inflation is a cause for concern when it gets to these levels, and I'm sure by now you know why sitting on a bunch of cash in the bank is probably not the best way to grow your wealth. You already lose an average of 2 to 3% per year on any cash that isn't invested, and that is the default amount you lose during a normal average year of economic growth. So if you've been pondering the idea of investing that pile of cash already, and now is the time to execute on that plan, so check out this video right here if you want to see my personal favorite way to invest some extra money. If you enjoyed today's video, be sure to leave a like down below and subscribe for more content just like this. And with that being said, thank you so much for watching, and I'll catch you in the next one.